time in which we're getting a lot of economic data on the U.S. economy, and Jim is seeing that. And when you see that generalist move in on the positioning, the managed money, on the COT report, again, I do that every week on this channel on the weekly market wrap. Watch that video. I tell you the positioning of the financial types, and you have Jim Cramer coming out. That means the journalists are moving in. That's when you get the biggest pops in gold and silver. Hey everybody, back with the weekly report for JM Bullion, and today I wanted to talk about Jim Cramer because I think everybody knows Jim Cramer, and Jim has been endorsing gold recently. This is the second time in about probably 3 or 4 weeks I've heard Jim Cramer talk about it, and I want to explain why we care about Jim Cramer in terms of the significance of why he's talking about it and how it's going to affect the gold market. It's not just the fact that he's talking about it, it's the fact that people that follow what he follows are talking about it. And that's really what's interesting, because I think it's a sign that the market is coming back. And I'll get to that in just a moment. But Jim has been talking gold. So let's take a look at Jim, and let's take a look at his calls, because everybody likes to analyze Jim Cramer and his calls because he's a guru. He's on CNBC, very famous guy. Everybody knows who he is. Everybody writes about him. So we're going to talk a little bit about his proficiency in making calls, and then I'm going to tell you why that's important for gold. I'm going to tie all of this together in just about 10 to 15 minutes. So let's get started. So Jim, as you know, works for CNBC. He has a show called Mad Money, and he's here suggesting that investors should ignore crypto cheerleaders and stick with gold. This is his show, Mad Money. And he doesn't say much in the article. He basically says, and I'm going to talk about Bitcoin just for a second. He's comparing Bitcoin and gold and which should receive money. And he's doing this because during the last cycle, some people thought that Bitcoin had absorbed some of the investor money that should have typically gone to gold, because Bitcoin was a potential alternative currency and safe haven. Just real quick on Bitcoin, this is Jim's viewpoint. I'm not espousing it, but he makes the point that Bitcoin and NASDAQ futures trade very similarly. So in other words, Bitcoin is trading as a risk asset like a stock would in its technology, so it matches up with the NASDAQ. In other words, Bitcoin is basically a marketable risk security, not money or currency, is Jim's point. Whether or not I agree with that, maybe we'll do a separate video on that, but he's basically making the difference between Bitcoin being like a stock or a risk asset and gold being the opposite, where you go when there is risk, but you don't want it because gold has no true counterparty risk, unlike a lot of other investments. Counterparty risk just means that somebody else is a risk to your investment. So if you're in the stock market, if that stock doesn't do well because everybody else doesn't like it, that's counterparty risk. Or if for some reason the person that you own that stock through sold your stock or loaned it to a short seller and you couldn't get access to it, or any number of things could happen. A regulatory event, a market event causes counterparty risk. And there's a lot of counterparty risk in a lot of paper-based investments. But gold, typically, if you hold it in your hands, not a lot of counterparty risk. You own it. The market's there for it. There's no contract on it that says you can't sell it, can sell it. You have physical access to it. So there's not a lot of counterparty risk. And I think Jim understands that, and he thinks that there's more counterparty risk in Bitcoin. Whether that's true or not, I'm just throwing that out there. And that was his stance. But the most important thing about that, even though he's talking about Bitcoin, is the fact that he's saying you should stick with gold. And he makes a point here as well in the article. The only part of the article I'll read right here, Jim is saying this in the interview. The charts interpreted by Carly Garner suggest you need to ignore the crypto cheerleaders now that Bitcoin's bouncing. And if you seriously want a real hedge against inflation or economic chaos, she says you should stick with gold, and I agree. So Jim is bullish on gold. Well, let's take a look at how Jim has done. We're going to look at a couple of different analyses of his calls. And the one thing that you have to understand is Jim makes a lot of calls. Some are big conviction calls. Some are things he talks about. So people have analyzed this a different way across different time frames. I'm just going to give you a couple of different ways. I'm going to explain why this is important in figuring out, is Jim right on gold? We will definitely get there. So the first one's by CXO Advisory Group. They're professional financial advisory, and they just did an interesting study. And they looked at the stocks that Jim looked at, I want to say between 2005 and 2006. So that's the time frame. And what they looked at was how well he did and his buys and sells, um, and on the return. So on the buys, there was positive return. On the sells, not so much. So he did well on certain ones where the caller made the pick. He did actually a little bit better, so I had a little bit of help. Anyway, they're just basically looking at how did he do with regards to his picks, and he did okay there. We had somebody that's a non-professional, that's just a user, who looked at all of his 600 and I think 87 picks, almost 700 just in 2021, and did some neat charts. And these charts are really cool. So he took all the calls and he actually looked at it from a time frame. When he did a buy, there's buy and sell, so we'll get to sell in a moment. On his buy recommendations, how did he do? Well, on the first day, he did well. And I think one of the reasons is because he's so followed that if he makes a pick on day one, everybody's going to jump in and it's going to boost the stock. And that's one thing I used to notice writing for Seeking Alpha is when you're writing for investors, and he's more powerful this because he's on TV, but I was on Seeking Alpha, which is a pretty powerful platform. A lot of people write about a lot of things on Seeking Alpha, a lot of the markets. These articles can actually move the market or they can influence other people. When I was on Seeking Alpha, I still am, I write occasionally. I'm followed by hedge fund managers, company executives, financial managers, family offices, people that have some money and can invest and move a stock if they want to. So I think this original performance on day one's because he's making the pick. Probably you can see 1 month and 1 week is not so hot. But here's the important part, and I think the part that plays into gold. The longer term, over a year period, he was hitting stuff at almost 2/3 correct calls. And if you look back at who Jim is, when I used to listen to his radio show years ago, I used to listen to his radio show all the time on in the middle of the day. And he's a contrarian. He's a self-proclaimed, self-described contrarian. And so he likes to make calls that aren't going to be popular in the immediate term, but are in the long term. And I think on his long-term calls, you see that even though the market likes it on the first day, they don't necessarily like it as much, but he gets it right over the long term pretty well. And so that's what a contrarian does. A lot of times you pick stuff that's not going to be popular, but it will do well over time. And I think Jim's done a pretty good job of that. Now, the immediate return's not great. And that's what people complain about in his articles. His stock, picks aren't performing well in the short term. So we're going to complain, but in the long term, he does pretty well. And in the long term, you don't get this boost from him recommending it in the long term. That boost, from my experience, you're going to get right off the bat. So if I published an article and somebody liked it and they made a position and the stock got a little bit of a boost on Seeking, it didn't always happen, but occasionally you noticed it kind of did. If somebody really liked your pick and they're a big money manager and they put money in, you could see a nice little bump off that stock potentially. And so I think if he's wrong on the picks, it would have shown up more here. The fact that he's right in the longer term means he's a contrarian. He's making a call ahead of time, and he's doing that to essentially give you what he thinks is going to do well and give you enough time to get in it. So I actually think he isn't half bad. Even though a lot of people complain about him, he's not half bad. He's just a contrarian. He's ahead of schedule. And yeah, all these picks aren't right, but nobody's are. But if you look at his sell recommendations, they're on the money. Longer term, some of these stocks could recover, but he's good at picking out where stuff needs to sell, and maybe you re-enter later. But he's really good on his sell recommendations. This is from a Redditor who analyzed 700. Now I'm going back to Seeking Alpha, and Quiver Quantitative wrote an article on the inverse Jim Cramer strategy. So the inverse Jim Cramer strategy is people take all his calls and they've formed an ETF to the opposite of what he recommends, and they actually do pretty well. So here's the inverse Cramer strategy. Now, this article was written more recently in 2023. So to be fair, the original article I brought you from CXO Advisory was from years ago. It was written in 2007. This is more recent, 2021. And then I'm giving you a super recent one, 2023, looking at 2022 and how he did. So in those previous year, if you traded against Jim Cramer, you did pretty well. That's a nice little strategy. 100 million investment would have compounded slightly more than 147 million today if one went against the CNBC host stock picking skills for the past 2 years. So he was looking at 2021 and 2022. And this guy was looking 2021, and there was a lot of red here until you got to the long term. But if you look at 2 years of data and look at, this is high conviction, by the way. So they're cherry picking the ones where Jim says, I'm really sure about this. If you traded against him, you did pretty well. And if you go down to the conclusion, it basically highlights what happens. Inverting Jim Cramer's highest conviction recommendations has yielded another quarter of extremely lucrative returns for our Cramer-based investing strategy. It ended the year on a strong note, gaining an additional 3.49% during the last quarter, and now outperformed the market twice in a row for a compounded annual growth rate of 21.85. So if you only looked at his highest conviction rate recommendations, and again, this article is cherry picking, not looking at it all, you did well in the inverse Cramer. But if you looked at all of his recommendations, you actually didn't do too badly when looked at over time. So I think this Reddit view is probably the most fair, but I wanted to provide several different standpoints. Now, I did find that Alan Roth back in 2022 had said, wait a minute, not so fast. Betting against Kramer is not always a home run. And so he did his own analysis. So again, a fourth opinion here from a professional in the space. He says Total Capital Management filed a prospectus to launch a new exchange-traded fund that would do the opposite of what Mad Money Jim Cramer suggests, whether it's buying or selling a stock. The firm filed for two ETFs, the inverse Cramer ETF, the SGIM, and the LGIM, the long Cramer ETF, which would be using his recommendations. That would be going long on the stocks he says to go long on. That would be agreeing with him. There's been much research showing Cramer's picks have underperformed the market. So could an inverse Cramer ETF be the next star? So on and so forth. In this inverse Cramer ETF, is it the answer? I think not. I've written that a statistical look at Cramer's performance and how Cramer made me 22% in 22 days when I bought the two stocks he said to sell immediately. I even suggested an inverse ETF in my Roth imaginary ETFs. The proposed inverse Cramer ETF has a stated objective of engaging in transactions designed to perform the opposite of the return recommended by Cramer. That means either using shorting or derivatives transactions using a negative correlation. He has mixed feelings. On one hand, I think following Jim Cramer's advice is foolish. On the other hand, I'd like to see long Cramer ETF do better because we need active investors to keep markets efficient. Cramer plays a big part in perpetuating the folly that keeps markets working. So his view is that inverse Cramer ETF will provide a service to investors that will track long-run performance of Cramer's picks. It's easy to track Kathy Wood's picks with ARK, but no security tracks Cramer's picks. So in other words, it's not necessarily a home run. He made some money off of Cramer, but he does recognize the fact that Cramer's picks don't always do well. And I think if you go back to the biggest analysis of his data, that's true in this time frame. Okay, so what does all this mean? I just sent a bunch of stuff at you, gave you different opinions on Jim Cramer. Here's the thing that I want to focus on. Jim Cramer's not always right on the stock market, but if you look at his sells and his long-term buy recommendations, he does very well. And that is what contrarians do. That is his trading history is the definition of being a contrarian. You sell when other people don't want to sell, because think about the American stock market. We don't like short sellers. We don't like sellers. We like buyers. We like to be long all the time. That's sort of the quote unquote American way. Now, there are people that will short. But a lot of it, when I was writing for Seeking Alpha, a lot of people criticize you if you said short a stock or go opposite the stock, or this is not a great stock because it was un-American. Some people believe that. So a lot of investing strategy in America is just go long, go long, go long. Jim is a contrarian by saying, I will sell at certain times, and I may make buy recommendations that in the immediate term aren't popular. But what those buy recommendations do is get you into or out of investment before you're going to experience pain. So let's go back and look at that one more time. Jim is right from a contrarian perspective if you want to get in a little bit early and ride it up. And he's right when to sell, the immediate term sells. So if you just use Jim Cramer's recommendations as a contrarian, all of a sudden it makes more sense. And I'll give credit for Jim here. He's being a contrarian to the rest of the generalists in the market by recommending gold. Most journalists don't ever recommend gold. Financial houses don't recommend it because they don't make commissions off it. It's not a paper product. And so they're not going to tell you to go buy a bunch of gold and put it in your house or put it in the storage facility. The storage facility is going to make the money, not the guy recommending it. So financial advisors, I used to work in, I used to have licenses way back when, don't anymore. And so disclaimer, I'm not your financial advisor. But I used to work in that field for a period of time for a couple of different companies. And what I noticed was people will put you in products that make them the most money that they also think will do well for you. And it's about the money that the guy that's recommending it, the broker or the investment advisor, is going to make as much as you making money. And I do think a lot of them have a good conscience and want you to make money, but they're also going to steer you to things that make them money. And so a lot of financial types won't put you into gold because it doesn't make them money. But Kramer is not making money as a broker. He's running a show. And so he can make any call he wants. And so I think there's actually more honesty in what Jim Cramer says with regards to gold than you'll see in traditional financial circles, because they don't make money off recommending gold. But Jim's not making money here. Jim is making a call on the market direction as an analyst, not as a salesman. Does he sell stuff? Probably. I'm sure there are sponsors of the show. But when and is gold one of them? I don't know. I wouldn't suspect so. I think Jim's just saying it because he saw the market sell off the last year. And he's like, where else are you going to go? Gold stood up as a safe haven. Bitcoin did not last year. Whatever you think Bitcoin could be whatever you think Bitcoin could be in 10 to 20 years, it wasn't last year. And that's a fair assessment. It had one of the biggest sell-offs in history. That's fair. It's just the data. The stock market sold off. The bond rates rose, which is negative for existing bondholders because it reduces your face value of your bond. It reduces your return if you want to sell. And rising bond rates is problematic because it means we're having issues in the economy. So most of the investment sphere in 2022 did not do well. However, gold and silver did well. They held value and gold actually gained a wee bit. And gold started off this year with a bang. And as I look at gold right now, I'm just going to look it up. We are at 3 p.m. on the 25th of January, 2023. And as I look at it, I'm trying to get the gold price to load. It's not loading at gold price, but we're above 1900. So gold has ridden. It's right now 1946.62, I believe. Silver's at touching on 24 bucks. It's 23.90, and gold right now is 1945.82. So we've had a nice little run in gold. We're mid 1900s. I wrote an article for JM Bullion on January 6th where I did a technical analysis of gold and said it would punch through 1900. And in the week ensuing, the week and a half ensuing, it did exactly what I said from a technical perspective. What's important about Jim, he's a generalist. And when generalists get into precious metals, it tends to drive them really hard and really fast. And I think that's potentially what could happen here. I do think that gold could go really hard, really fast, potentially, depending on what we see in the market. If we see a big event, a big geopolitical event, if we see a bank failure, anything in which people would say, I want to get out of the generalist paper market and I want to get into something physical, they're going to come to gold and silver. And I think we're headed that way. And I think that we are getting pretty close to the time at which, if we're going to have a breakout in the gold market, it's going to come sooner rather than later. We just need that catalyst. And I think Jim sees what's going on in the world. He sees the performance of the rest of the market because that's what he does. And I think that he knows that we're going to have a pop in gold. And it's important because when a generalist with the power of Jim Cramer says it, it causes the market to dive in. Now, I'm not going to give Jim credit for starting the generalist movement in gold, because if you watch our weekly market wrap-ups here on JM Bullion's channel, every week we look at the positioning on the futures market. The futures market is where the gold spot price is determined. And we saw the managed money types, the generalists, if you will, getting into gold for the last month and a half, 2 months. Leading up to the end of the year, you could see the hedge funds and financial types putting more money into gold. They were 2-to-1 long on gold. And they haven't been 2-to-1 long on gold on the futures market in a long time. What does 2-to-1 mean? It means they have twice as many long positions as short. And that's aggregating all the financial advisors. So some are going to be short, some are going to be long, some are going to have a hodgepodge. But you look at it net, the financial sector, the last 2 months has been bullish gold. Jim has started to talk about gold. Those two factors are showing that the generalists are bullish on gold. Now, if you want to look at my own individual technical call, I did some Fibonacci's here. If you want to know what Fibonacci's are, read that January 6th article on jmbullion.com/blog. And I explain this in detail, but essentially I called back here the breakout above 1846 through 1900. And our next stop is about 1950. And the next stop is about 2000. And then the next resistance line is at 2067. From a technical perspective, I could see us going right back to the all-time high in gold of 2069. It's basically this trading level pretty quickly. It would only take a moderate amount of news. We're sitting at 1946 now. It's about 130 bucks. It's not going to take a lot to get gold back up there. Will gold stay above 2000 this year? It depends on what we see in the economy. The first thing that I said at the beginning of the year, gold will do well if the earnings reports for Q4 are not great and the consumer did not spend a lot. Now, we look at financial data every week on the weekly market wrap, and retail sales for December were down 1.1%. And if you look at retail sales and inflation, we basically had a very modest decline year over year in consumer spend during the busiest time of year, Q4, especially the last 2 months of year is when people spend. That's why it's called Black Friday after Thanksgiving. It's where retail companies get into the black. They make money because everybody's buying for the holidays. And so I said, depending on how the earnings reports would go is how gold will go. Well, very early on in the tech stocks, Microsoft, Amazon, whoever else were laying off a bunch of people. Now, it wasn't hundreds of thousands, but it was 10 to 12 to 15. And those layoffs are an indication that people need to cut costs. And if we continue to see that throughout this earnings season, not only for Q4, but remember for companies ending the year on 12/31, you get the annual reports. Those tend to come out a little bit later because you have all the audits. I'm a former auditor, so you got to go through Sarbanes-Oxley. So you may not see the year-end reports until, for some companies, till March and April, when all those audit reports are done and they've issued, all of their. So I think the next couple of months is going to be a good indicator of how companies not only did in the Q4, but how they did in all of 2022. And the way that those are coming out now, it looks bullish for gold because it looks like we've had a bit of a pullback. I mean, that makes sense because in 2022, we had the big stock pullback. But what happens is the earning reports come out and all that data comes out, the generalists see it and they go, bad year. I don't know what's going to happen this year. Let me go to safety, bonds, dollars, gold. Let's see. Bond higher interest rate means I'm probably going to lose money over time if those keep going up because I'm going to lose face value. So I may want to get into that limited. The dollar has been falling. The DXY has been falling. Gold's doing well. What am I going to do? Gold. And so I think you saw at the beginning of the year, not only generally it's going in gold because they're positive about it, but also people going back into the markets in general, which happens in January. We're not through January, so we're going to see February, March if this continues. Part of the move into gold now is people just reinvesting, but they're investing in gold versus other things. That's why it's moving up. But I want to see the earnings reports and I want to see the Fed's reaction to the earnings reports and what they're going to do with interest rates before I call, are we going to hit gold 2069, the all-time high? And if a lot of those things happen with the economy, we will hit gold 2069 and we'll start doing new territory where gold's never been before on the charts. And we'll start talking about that. Where is support going to be? Where is gold going to come back down to? What's it, we're going to be in uncharted territory and we're very close, guys. We're just 120, 130 bucks off of the all-time high in gold at a time in which we're getting a lot of economic data on the US economy. And Jim is seeing that. And when you see that generalist move in on the positioning, the managed money on the COT report, again, I do that every week on this channel on the weekly market wrap. Watch that video. I tell you the positioning of the financial types. And you have Jim Cramer coming out. That means the journalists are moving in. That's when you get the biggest pops in gold and silver. All of us hardcore guys who are in it all the time are always going to be in it to some extent. When you have the rest of the market, the other 99.5% of the market that typically does not invest in gold, start to put even a little bit of money in there, that's when you get a boom, you get a big pop. And all it's going to take is one piece of news that's negative on the economy, on geopolitics, on the banking system, on the dollar, on anything that are paper assets or that could cause the market to say, we're in risk. If somebody declared war on somebody else tomorrow, risk. If a bank fails, risk. The generalists go in. Now they've already started to move in, which is why gold is moving up. This has been a generalist investment into gold. Not only us every day, 0.5% of Americans are actually in gold every day. The other 99.5% starting to take notice, but with the very beginning of that, this thing could go much higher. So we need a catalyst for it to go higher. But the financial types, the generalist investors are already starting to position in gold now. And that is so bullish. And so why did I look at Jim Cramer and the inverse Jim Cramer strategy and his calls? because this man has done pretty good with long-term contrarian calls. And I don't think he's stupid on gold here. But more importantly, just the fact he mentioned gold means that other people like him are thinking about it. And that's why the money's coming in. So that explains why gold is popping, much like I said it would. It popped a little faster than I thought it would. I thought we would get more into the earnings report season first. But hey, I'll take it now. I'm not complaining. And this is very, very bullish for gold when you see the journalists come in. And when a guy like Jim Cramer comes in, who everybody knows, regardless of what you think about him, it's going to cause everybody else to turn around and say, Jim Cramer's talking gold. Do I need to start looking at the shiny stuff? And that's where you're going to see movement. All right. This has been it. Jim Cramer endorses gold. Is he right? I think he is. But we're going to see. Stay tuned to this channel, JM Bullion, on YouTube, where we cover it. And if you want the written stuff, I do 2 articles a week. I do a macro analysis for 1 article and another article to help you navigate the gold silver market, educational. Go to jmbullion.com/blog, and we will have that information for you. Until next time, this has been Rob Keens, your host with Gold Silver Pros for JM Bullion.